I want to explain how technical analysis works using Tesla as an example, as some traders are worried that Tesla is breaking technical support levels. Now, I humbly recommend doing fundamental research and valuation-based research before looking at technical analysis, which is what I refer to as FVT, fundamentals, valuation, and technicals. My FVT approach to doing investment research, I teach in my courses and my MBA degree program as well. Now, the first thing that we need to look at with technical analysis is what is referred to as the RSI, or the Relative Strength Index. So let's look at Tesla's RSI, or Relative Strength Index, together. And all we do is we go to finance.yahoo.com and you type in the ticker for Tesla, which of course is TSLA. Then we select the chart here. If you don't see the RSI on the bottom of the chart here, which I'll explain in a second, you click here on Indicators, and then you select RSI, meaning Relative Strength Index. And the default is 80, I'll explain this in a second, means overbought. 20 means oversold. I'll show you what this means. Okay, so at the very, very bottom here, you could see the RSI. And I'll make this a little bit bigger here. Okay, cool. So at the bottom here, you'll see 20. Okay, it's tough to see, but it's a little red 20 right here. And this down here, this 20 means the stock is oversold if it hits this level in the chart above. And give me a second to show you, okay? Okay, so when it's close to this level, traders think, hey, the stock is oversold, I'm gonna buy it. And so it doesn't always work, but you can actually see it right here, okay? It's close to 20 RSI oversold. And on the stock chart up here, you could see it was oversold and it bounced back. Okay, it doesn't always work perfectly, which is why we look at fundamentals first, valuation second, and technicals last. Now, what we can also see here is if it's overbought, which is a reading of 80, which is a little bit tricky to see here. Let me draw this line here. I wish I could draw straight lines, man. Okay, and when the stock is somewhat overbought, meaning it passes 80 on this level here, some traders tend to sell the stock, right? They think that given mean reversion, too many people have owned it and it's going to pull back. The same thing happened right here as well, and a little bit right here to a lesser extent. Now, I believe in looking at fundamentals and valuation first because I think every single year your portfolio comes down to 1, 2, or 3 stocks that do exceptionally well. And I always try to look for 5x5s when I invest, which means a 500% return within 5 years. I'm wrong a lot of the time, but if I'm right on a 5x5, it usually means it goes up at least 100%. The problem with technical analysis is we try to fight to make 5 or 10% here or there, and it's quite random every now and then. So yes, I do respect technicals, but a little bit less so than I respect fundamentals. Okay. Next thing we're going to look at here is moving averages. Okay, the 50-day moving average as well as the 200-day moving average. So let's go back to Tesla and take a look at the 50-day moving average and the 200-day moving average. Okay, so if you don't see the 50-day and 200-day moving average here, you can draw them in here by going to Indicators, Moving Averages. Okay, 50 is purple. And then we'll add the 200-day moving average as well. And basically what this stuff means is it means what is the average movement of the stock over the past 50 or 200 days. Okay, so right here we have the moving averages. So this here is the 50-day moving average. And sometimes what happens is it's self-fulfilling. It matters because it does to certain traders. But what happens is it holds support at those moving averages. So let me show you what this means. Okay, so let's look first at the 50-day moving average here. Okay, this line here, which is the average price of the stock over the past 50 days. You see right here, it tested the 50-day moving average and it bounced. Okay, and usually the rule is that I like to think of, if it goes 1 or 2% below the 50-day moving average or any moving average, that's okay. Let it go there. But if it goes a lot below, then sometimes it can trigger stop losses, meaning investors will sell immediately. They'll shoot first, ask questions second. So right here, it sort of tested it. Here it tested it and broke down through more than a couple percent. And then we saw a precipitous sell-off here. Okay. All right, so that's the 50-day. Now, let me change colors here, see if I can do this. We'll go green. So the green, I'll talk about the 200-day moving average, okay? This guy up here, although it's a red line. So this is really important because if it violates this level more than a couple percent, then people can freak out. And given the fact we've been in a ridiculous bull market and everything is melting up, and this won't last forever, I promise you. But given the fact we've been in a big bull market, meaning stocks have done well, not many stocks have tested the 200-day moving average. But right here, it's a key level for Tesla because it's starting to test that level just a little bit. And one of the reasons the market has pulled back quite a bit over the past couple of days or so, but I'm a long-term investor. But one of the reasons it's pulled back is because the Federal Reserve, meaning the entity in the United States in charge of increasing and decreasing interest rates, has started to imply that, hey, we might actually start raising rates because inflation is up, right? The price of lumber is at an all-time high. You can't find semiconductor chips. The used auto market actually is up 10% month over month, which is the biggest increase in history. Okay, so that explains the 50 and the 200-day moving average. Now, next up, let me delete my scribbles. Next up, I want to talk about something called a golden cross, okay, which is bullish, okay, meaning positive. And a golden cross is when the 50-day moving average goes up through the 200-day moving average. And let me show you what this means. All right, so here we have a hypothetical situation. And let me go here to get my mouse to work. Sorry, tough doing this live, but fun. I like the challenge. All right, so let's assume that this here is the 50-day moving average, okay? The average price of the stock over the past 50 days. Then let's look at another line here. Let's assume this one here is the 200-day moving average, okay? 250. So right here, we see that the 50-day moving average crossed up through the 200-day moving average, okay? And that's very positive. That's called a golden cross. Now, the opposite of a golden cross is a death cross. Okay, so let me just delete this screen here and we'll draw it again. Okay, so the opposite is here. So let's go to, here we go, good. All right, so this, let's say this here is the 50-day moving average. Okay, and then right here we have the 200-day moving average. Okay, so 200, and then we have 50. Now, right here we see that the 50-day moving average cross below the 200-day moving average. And that's usually pretty bearish when it comes to technical analysis. Okay, let me delete all those drawings and let's move on. All right, so the next technical indicator that traders look at is something called technical support or technical resistance. And it's similar to the 50 and 200-day, except it's just a line that's either violated or it's not. So let's look at an example of this. Okay, so let's pretend that this here is a stock. Okay. Now, what you can do is, what people do is they look at resistance and support levels. I'll get there, guys. Sorry. It's fun doing this live. Okay, good. Here we go. And then I'll go just in green this time. Here we go. Yeah. So right here, if this is the stock, right, the top line, it looks like right here, it bounced off the support level multiple times. Okay. And people like to look at that and think of that as a technical support level. If it doesn't break that level below more than 1% or 2%, then people think it will accumulate higher. And the opposite is true as well when you look at technical resistance. Okay, so right here, the stock did not break through the technical resistance level, boom, boom, boom. And then boom, it did more than a couple percent here, and we're off to the races, and people started accumulating. And hedge funds, and I know this for a fact because I used to work in the hedge fund industry, hedge funds will freak out if they're short a stock that breaks up through technical support, and they'll cover their shorts. And buying begets buying begets buying, because when you cover a short or close a short position, which means when you bet against the stock, when you cover a short position, you're buying the stock. And so people panic buy. I've seen it happen many times over the years. All right, next up, we have what's called a channel formation. And let's look at Tesla stock for an example of channel formation. So what I'm going to do is I'm going to draw what I believe to be the channel, or at least what technical investors think is the channel, okay? So let's just say right here, okay? And it's not a perfect science, but you can see here that we're at support, support, support. We didn't break through, we didn't break through, we didn't break through. And on the high end, we're close to resistance, resistance, resistance. And then we broke up more than a couple percent. And right here, this is where traders would cover their shorts, okay? Because they would break up to the upside. Now, if we keep looking here, we see here, it broke the low end of the channel. Okay, and that's pretty bearish, and that's why a lot of investors have been selling, among other reasons too. There's usually reasons why stocks go down outside of technicals. Okay, so hopefully that makes sense. Now let me clear up my awful drawings there, and let's move on. All right, so next up we've got hold on a second. I think I've covered everything. Yeah, no, I've covered all of them there. Okay, great. So the bottom line is, we look at fundamentals first, valuation second, and technicals a distant third. Why? Because if we only looked at technical analysis, we know that technicals are not always accurate, which I just showed you. And more importantly, if we ignore fundamentals and valuation when doing our investment research, then we'd freak out every time that the market sold off. And what would happen is we would end up becoming tourists in the stock. We'd just be renters of them. That's my tourist graphic up there.